Now, today's sell-off is just another opportunity to buy. If you ask Chris Hyzy, he oversees $367 billion as Chief Investment Officer of U.S. Trust, a division of Bank of America Merrill Lynch. Welcome to Closing Street Smart. Thanks for joining us. It's not that you think people should just go out and buy everything they see willy-nilly. You think that this is an opportunity to rebalance, an opportunity to reinvest, and there is a lot of cash on the sidelines that you think has to be put to work.
Yeah, no question about it. I think if you just start and go back and you look at the reset button, obviously 2008 was when the credit market broke. That reset a whole dial down in risk overall. Leverage coming down, liabilities holding flat, asset prices being stabilized. That's the sweet spot for equities. It's the back end of the credit cycle. That's where we are. There's going to be a lot of headwinds in there where you're going to get opportunities like the carry trade unwinding, stronger dollar, lower euro, lower commodity prices. It's time to rebalance into those things.
Chris, but you think it's too early to rotate to those defensive names. We were talking with Julie earlier, and she talked about how a lot of the defensive areas have really outperformed the market, whether it's utilities, whether it's healthcare, whether it's those staples names.
Yeah. At this point in time in the cycle, it is way too early to do that. The sector rotation into the defensives usually happens when the Fed goes too far. We can argue the Fed is not going too far and tapping the brakes because they haven't even done it yet. So you're going to get bouts of this here and there. When you have the spookiness going on in Europe as well as what's happening in China, it's a growth scare. It's not a concern. In our opinion, we'd be rebalancing back into these areas.
Why don't we bring Julie in right now? Julie's defensive stocks have led gains recently. What do you say?
Well, they have led gains recently, and so that's led some folks to say, well, indeed, this rally is running out of steam. That's what we've seen in recent days with the pullback that we've seen in stocks. But on the flip side, Barini Associates, as I mentioned earlier, went back and looked at the times that defensives have outperformed, and the overall market actually went to go on to outperform. This is what you've seen the defensives do since the low on March 16th. So, Chris, do you agree here that, I mean, it would seem that, again, as you guys have been talking about, that defensives outperforming would be a bad sign, but do you think, sort of contrary to that, that cyclicals are going to come back and do all right here?
Yeah, I think the third quarter and fourth quarter of this year, you'll see a re-acceleration of growth. There's a little bit of tapping on the brakes in the emerging markets to control inflation. So the same pundits that basically were out there before saying that, you know, China needs to slow things down, inflation's a scare, now they're saying perhaps there's a growth scare. When we will look back at last summer, the peak to trough movement in the summer was some 16%. We're not looking for that this time around. It's more of a sector rotation, as you've mentioned, Julie, into defensives and away from cyclicals. But the cyclicals are actually holding their own overall, which is why the market and the volatility in equities is not as high as you would expect at this point in time in the cycle.
What happens, though, if, and a lot of people are saying when Greece defaults, and that sets off a domino chain reaction in Europe? And at the same time, you know, Chinese inflation may be getting a little out of hand. They want to put the brakes on over there. We are just bickering about a debt ceiling that we're clearly going to raise, but is that really a good thing?
Yeah, I think the market is assigning a probability of 1 to all the bad things, and they're assigning a probability of 0.1 to all the good things. The profit cycle, payrolls improving, policy actually moving in the right direction.
Those bad things are kind of big. I mean, take the European debt crisis. Well, we're a year in counting and dealing with this. Yeah. The deficit, we've been several years in counting, and then Asia's slowing down its growth.
Yeah, and the question is, how much will that impact the profit cycle globally and then in the United States? All the work that we've done, the profit cycle is an engine that's far too strong to slow down right now, even in the face of the headwinds in Europe. Let's just say, assume the worst case scenario, there's a restructuring, there's a workout. Who takes the actual hit on that? That's the debt holders. Who takes the hit here in the United States as it relates to all of the public sector debt off of the private sector balance sheet? That's the banking system. I'd argue that most of that hit's been taken.
You know, we spent some time talking technicals earlier with John Roque. Adam, I want to bring you back into our discussion because you were looking at those technicals. I mean, we closed below a key line of support for the market, didn't we?
Carol, yes, the uptrend is broken. And Chris, I've got a chart because I know you're bullish and you see this as an opportunity to rebalance, maybe even buy the dip. But look at this. That green line is a 9-month support line. All right, we closed above it. So the uptrend has been broken. And let's say we go down 2%, 5%, 10%, whatever it is. Chris, my question to you is actually twofold. Number one, how far down do we go? And at what point do you actually say this is too painful? And number two, what are you doing to protect the money that's invested right now? Are you buying puts, for example?
Yeah, that's a good point. Yeah, risk management is a clear winner out in all of this case. In the summer months last year, that was the right strategy. We're going to do the same thing here around. We're actually going to protect most of our long duration positions with put strategies. I would say this, though, in the terms of the technical picture, 1290, 1300 is where we, for technical readings, would get to a certain base. And last year, we broke through that as well, just like we're doing through right now. As I mentioned before, the fall down was 16%. We came storming back because of the Jackson Hole speech. I think you're going to see that again mid-year this year, but at the Fed's mid-year report to outline exactly what they're doing in terms of policy, and that should ignite a lot of the cash that's off the sidelines, on the sidelines right now, off of them back into the equity markets.
Do you think we'll see another Jackson Hole speech? Another QE?
No, not another QE, but the opposite. Actually unwinding what's been put in place over the last couple of years. The initial stages of that is a concern to the markets, particularly those investors that have had short dollar and long higher yielding things. That's what you're seeing right now.
Right.
You're seeing a covering of that carry trade, and we think that's not necessarily going to get put back on towards the end of the year, but the profit cycle is moving forward and money coming off the sidelines into equities is the right strategy.
That's strong enough. The profit cycle is strong enough to, no matter what happens with QE, even if we have an enter, because we bring in other folks who say, nope, that's certainly going to rattle the market.
Well, certainly I don't think QE2 would be unwound if the comfort level with the profit cycle and payrolls wasn't high at the Fed.
I want to talk about emerging markets for a second, and we'll get Sheila's take first, then we'll ask you about it. Sheila, you've been tracking the sell-off around the world, and it's particularly strong in the emerging markets.
Yeah, emerging markets really on a losing streak. Overall, if you take the emerging markets index, down about 2% today. And particularly when you take a look at the BRIC countries, these countries that have been fueling growth, seeing sell-off there as well. So whether you're talking about India, Russia, or Brazil, we are starting to see investors pull back. I took a look at some fund flow data as well. And yes, the redemptions are still modest at this point, but the point is they're happening. Folks are starting to pull back from emerging markets. And of course, you're also starting to see a lot of these emerging markets bears come out of the woodwork. So the latest one being a strategist from Deutsche Bank, John Paul Smith. He actually said recently that governments became addicted to top-line growth between 2002 and 2007, and we're just not in that environment anymore. Chris, I know you're a fan of the cyclicals. How does this play out in emerging markets? Are there any countries that you're specifically bullish on?
Well, certainly, yeah. Singapore, Taiwan, Korea, even Brazil, even at this stage, they're down for the year. But we're in favor of those countries. Strong demographics, good political landscape, still a very steep bond market overall. And I would point out one thing in terms of the inflation outlook in the emerging markets. Most of it's subsidized on the food and energy side for a lot of the countries in Southeast Asia. Labor costs are a big issue. If they start exporting that to us in fashion and long-run inflation, that's where I would get concerned with the U.S. outlook. But it's a tale of two types of geographies in the emerging markets. You've got the inflation scare, and then you have the growth scare. In the long run, they're going to be just fine. The short run, India with an inverted yield curve is a market that I would not be looking at right now, and that's a sure sign that there's going to be some growth concerns going forward. And let's also talk about the cyclical picture real quick here. We're working off now this part of the cycle in the United States where you have a situation where the U.S. consumers actually increasing their income. Believe it or not, it's actually happening right now. Payrolls are adding to this. As payrolls come in and profits hang in there with the U.S. With S&P, that's where the growth scare isn't much of a concern as it would have been last year in the emerging markets.
We got to run. Chris, good to get some time with you. Chris Hyzy, everybody, joining us.